Ladies and gentlemen, thanks for joining me. Today we'll be discussing value stock picking strategies. One of the objects of these videos is to present you with a range of techniques and strategies for picking stocks. Some of you will find one or two and get very good at applying these, and this is just fine. Others of you will learn all of them and learn which ones to apply in any given situation. Again, you have choices, and how you go about doing things is up to you. In keeping with this idea of presenting choices for you, the next stock picking strategy we'll examine is value investing. Value investing is perhaps the most utilized stock picking strategy. David, Dodd, Benjamin, and Graham, roughly 70 to 80 years ago, structured the framework for value investing. Like all really great things, the concept behind this is really quite simple. You strive to find companies that are presently trading below their inherent worth. The value investor looks for stocks with strong fundamentals, including earnings, dividends, book value, and cash flow, that are selling at incredibly low costs given the quality of the actual stock. The value investor seeks companies that seem to be incorrectly valued, that is, undervalued by the market, and therefore have the potential to increase in share price when the crowd finally realizes this and the market corrects this error in valuation. Before we get too far into the discussion of value investing, I wish to make something very crystal clear. Value investing, as I present here, does not mean just buying any stock that declines in price and therefore seems cheap in price compared to where it was. Value investors must do their homework and be confident that they are picking a company that is cheap by the standards of that company's high quality. Here, it's important to understand the difference between a value company and a company that simply has a declining price. Say for the past 10 years that company A has been trading at about $25 a share, but suddenly drops to $10 a pop. This doesn't necessarily mean the company is selling at a discount. All we are aware of is that the company is less expensive now than it was. The drop in price could be a result of the market responding to a fundamental problem in the company. To be a true bargain, this business must have fundamentals healthy enough to imply it is worth more than $10 a share. Remember this, value investing always compares current share price to intrinsic value, not to historic prices per share. Warren Buffett, one of the greatest investors in the world, has proven that value investing can and does work. His value investing tactics took the stock of his holding company, Berkshire Hathaway, from $12 a share in 1967 to $70,900 a share less than 40 years later. The company outperformed the S&P 500 by a 13% average annually every year during that time span. Now, although Mr. Buffett does not strictly categorize himself as a value investor, many of his home run investments were made on the basis of value investing principles, as set forth by his mentor Benjamin Graham. Yes, Warren Buffett is probably Benjamin Graham's most adept student. He is certainly the most successful. I have to emphasize that the value investing mentality sees a stock as the vehicle by which a person can become an owner of a company. To a value investor, profits are made by investing in quality companies, not by trading stocks in and out of the market at the drop of a hat. So if you have a day trader mentality, there's nothing wrong with that per se, but value investing is not going to work for you, because their method is about determining the worth of the underlying asset. Value investors don't pay attention to the external or outside factors affecting a company, such as the market's volatility or daily price fluctuations. These factors do not limit themselves specifically to the company, and therefore to the value investor anyway, are not seen to have any effect on the value of the business in the long run. While the efficient market hypothesis, the EMH, claims that prices are always reflecting all relevant information, and because of this, they're already reflecting the intrinsic values of businesses, the value investing relies on the premise opposing that theory. Value investors bank on the EMH being true only in some academic fantasy land. Value investors seek out inefficiencies when the market assigns an incorrect price to a stock. Value investors also disagree with the principle that high beta, aka standard deviation or volatility, directly transforms into a risky investment. A company with an intrinsic value of $20 per share but is trading at $15 per share would obviously be an attraction to value investors. If the share price dropped to $10 a pop, the company would experience a beta increase. Most investors feel that a scenario like this represents an increase in risk. But if the value investor still insisted that the intrinsic value was $20 a share, he would deem this dropping share price as an even better deal. And in this case, the better the bargain, the lesser the risk. A high volatility in the share price does not scare off value investors. Assuming they are confident in their intrinsic value labeling or their valuation, an upshot in downside volatility may be incredibly good. Now that we have a clear picture of what value investing is and what it is not, let's get into some of the qualities of value stocks. Qualitative aspects of value stocks. Number 1. Where are the value stocks found? The answer here is simple: everywhere. Value stocks can be found on the NYSE, that's the New York Stock Exchange, the NASDAQ, the Amex, which is the American Stock Exchange, or the OTC, and that's the over-the-counter. They can also be found on the FTSE, Nikkei, and plenty more. Number 2. In what industries are value stocks located? Again, the answer is simple. Value stocks can be found in any and every industry: energy, finance, even technology, though many people might feel otherwise about the last of these. Number 3. In what industries are value stocks most often located? Now here, the answer is not so simple. While value stocks can be found in most places, they are more often located in industries that have recently struggled, or are currently facing market overreaction to news affecting the industry in the short term. Just to cite an example, the automobile industry's cyclical nature allows for periods of undervaluations of companies such as Ford or GM. Number 4. Can value companies be those that have just reached new lows? This is a definite possibility, but I must re-emphasize that the cheapness of a company for the value investor is always relative to intrinsic value. A business that recently hit a new 12-month low or is at 50% of a 12-month high may warrant a deeper look. Now, here's a breakdown of some of the numbers value investors use as a rough guide for picking stocks. Keep in mind that these are only guidelines, far from being etched in stone. Number 1. Share price should never be more than 2/3 of intrinsic worth. Number 2. Check out companies with price-to-earning ratios at the lowest 10% of all equity securities. Number 3. PEG ought to be less than 1. Now we'll discuss PEGs a little bit more in just a moment. Number 4. Stock price should be no higher than the tangible book value. Number 5, there should never be any more debt than equity, and for example, debt to earnings ratio is less than 1. Number 6, current assets should be at least double the current liabilities. Number 7, dividend yield should be at or over 2/3 of the long-term AAA bond yield. Number 8, earnings growth should be at or over 7% per annum, compounded over the last 10 years. Contrary to what most think, value investing is not solely about investing in low price-to-earnings stocks. It's simply that stocks that are undervalued will frequently show this undervaluation through a low price-to-earnings ratio, which should provide a basic way to compare companies within the same industry. For example, if the average stock price-to-earnings ratio of technology consulting in the consulting industry is 25, a company trading in that industry at 20 times earnings would probably call attention to themselves from investors. Another popular measurement for deciding a company's intrinsic value is the PEG ratio. This is the stock's price-to-earnings ratio divided by its projected year-over-year earnings growth rate. In other words, this ratio shows how cheap the stock is while also considering its earnings growth. If the business's PEG ratio is lower than 1, it is labeled as undervalued. One familiar and accepted fluctuation on the value method of choosing value stocks is the net-to-net method. This method suggests that if a company is trading at 2/3 of its current assets, no other calculations for company worth is necessary. The logic behind this is clear. If this is the level the company is trading on, the buyer is essentially getting all permanent assets of the company, including equipment, property, etc., and the company's intangible assets as well, mainly goodwill in most cases, and they're getting all of this completely free. Sadly, companies trading this low are rarities in this day and age. They're almost mythical creatures. This discussion would not be complete without mentioning the use of a margin of safety, a strategy which is simple yet very effective. Using a margin of safety works similarly in value investing. It's merely the practice of leaving a margin of error in your calculations when figuring out a company's intrinsic value. A value investor may be quite confident that a company has an intrinsic value of $35 per share. To be sure his or her calculations aren't a little too optimistic, he or she will create a margin of safety or error by using the $30 per share in this scenario analysis. The investor may find that $20 the company is still an attractive company. If he or she may find that at $29, the company still doesn't have the necessary attraction. If the intrinsic value of a stock is lower than the investor's estimate, this allowed for margin of error will help prevent this investor from paying too much for the stock. Now, value investing is not as flashy as some other styles of investing. In fact, it's downright stodgy in comparison to everything else since it relies on a strict screening process. Just remember, there's nothing boring about outperforming the Standard & Poor's 500 by 13% over the 40-year span that Warren Buffett did. There is nothing boring about copious amounts of financial success. I'm sure you all agree. If you are as disciplined as others, there is no reason why you yourself can't do this as well. So, enjoy.